Have you ever looked at your portfolio and just wished it could generate a massive chunk of cash every single month without you having to actually sell off your hard-earned shares? I mean, for a lot of us, high-yield income is basically the holy grail of investing. Well, today, we are looking at an incredibly fascinating asset that promises to do exactly that. We're talking about the SPYI ETF. It's essentially this high-yield mystery machine that's been seriously turning heads across the investment world lately. Okay, let's dive into this. Welcome to everything you need to know about finance. Today's explainer is going to completely demystify how this unique asset actually works.
I mean, just think about a number like 11.8%, an 11.8% annualized distribution yield. In a world where your standard bank account pays literal pennies and traditional dividends are stuck in the low single digits, seeing a yield up near 12%, that's enough to make absolutely any investor stop in their tracks. But how on earth is that even possible? Well, we're going to unpack exactly where that cash comes from. Now, just real quick, this is not financial advice, just a deep dive into the mechanics of this asset. We're just here to learn how the engine works under the hood. And hey, if you find this kind of content interesting, please like and subscribe so we can keep bringing you these deep dives.
So to understand that massive yield, we first got to define what SPYI actually is. At its core, it's an income-focused ETF, but it's really more of a hybrid. Imagine taking a standard S&P 500 index fund, the kind that tracks the biggest companies in the US market, and fusing it together with a highly specialized options income engine. The goals here are pretty simple on the surface. Track the S&P 500 and generate high monthly income through an options strategy. It's kind of like renting out the stocks you own for a monthly fee, and then it distributes most of that income right back to the investors every single month. It's literally the perfect fusion of traditional stock ownership and advanced options trading, all wrapped up into one single ticker.
All right, let's break down the mechanics of how this actually operates step by step, because it's a beautifully designed system. Step 1, the fund owns or gets exposure to the stocks in the S&P 500. So far, pretty normal, right? But step 2 is where the magic really happens. The fund generates extra income by selling call options against that portfolio. It's essentially collecting those rental fees we just talked about. Then, step 3, buyers out in the open market pay SPYI premiums to purchase those options. And finally, step 4, those premiums become pure income, which SPYI turns around and distributes as cash to its shareholders every single month. That options income is the absolute secret sauce here. It is exactly what allows the fund to pay out those massive distributions compared to a standard, plain vanilla index fund.
Now, looking at this incredibly efficient income engine, the absolute most common question we get is, wait, is that 11.8% actually guaranteed? And the stark, honest answer is a flat no. This is probably one of the biggest misunderstandings out there. That 11.8% represents annualized distributions based on a very recent time frame. The reality is, payouts rely heavily on option premium income, along with underlying dividends and capital gains. It's not just traditional corporate profits like you'd get from holding a blue-chip stock for the past few years. Because those option premiums fluctuate wildly based on market volatility, the yield changes right along with them. So one year, it might be 12%. The next year, it could drop to 9%. Or, if things get crazy, it could spike up to 13%.
So, as great as it sounds, this high income isn't just free money magically appearing out of thin air. There is definitely a catch, a bit of a mystery box, if you will, when it comes to utilizing this strategy. We know it pays out beautifully when things are perfectly stable, but what happens when the market crashes? What is the really dangerous downside to selling away these options? Well, I want you to stick with me through this next section because we are going to reveal exactly how this fund behaves when the market turns ugly, and it's absolutely crucial to understand this before you ever consider an asset like this. Now, what's really interesting about this slide is the bull market trade-off. Over the past few years, we've seen some absolutely incredible surging bull runs in the market. Let's say the S&P 500 surges by 25% in a single year. A normal ETF like VOO or SPY is going to capture almost all of that growth. But SPYI, because it sold those call options, it effectively capped its own upside. So instead of a 25% price gain, SPYI might only see a 10 to 15% bump in price. Now, obviously, you also get that 10 to 12% in cash distributions, so you still make money, and your total return is definitely competitive, but you will almost certainly lag behind a plain index fund during a roaring bull market. You're basically trading away your maximum upside potential in exchange for steady, immediate income. But what about a slow downturn? Say the S&P 500 slowly drops 10%. SPYI is going to lose value too because its underlying portfolio is tied directly to the market. But here's the thing, those option premiums we talked about, they actually act as a really nice little shock absorber. In a scenario where the standard index drops 10%, SPYI might only drop somewhere between 7 and 9%. The extra income generated from selling the options offsets a chunk of the losses. It softens the blow for sure, but make absolutely no mistake, it certainly does not eliminate the loss entirely.
And here, finally, is the payoff to our mystery box, the severe market crash. If we look at historical equivalents of massive violent crashes, think 2008 or early 2020, we see that SPYI is absolutely not a safe haven. If the S&P 500 plummets by 35%, SPYI is going right down with the ship, likely falling somewhere in the range of 25 to 35%, really depending on the exact option income generated during that drop. On top of that, those massive monthly distributions you rely on can actually be reduced during difficult market conditions if the fund struggles to generate enough premium. The key takeaway here is just vital. SPYI still carries significant stock market risk. A high yield does not mean it's a safe investment.
Okay, let's rapidly summarize the 4 biggest risks here just to make sure we're looking at the full picture. First up, market risk. Like we just saw, if the S&P falls, SPYI falls right with it. Second, reduced upside. In strong bull markets, your gains are strictly capped by the options you sold. Third, variable distributions. Your monthly payout is never guaranteed and will absolutely fluctuate with market volatility. And finally, tax complexity. Depending on where you live and how the payout is legally structured, a portion of these distributions can be classified very differently for tax purposes than your standard dividends.
To really put all of this into perspective, let's look at a super simple real-world analogy. Imagine 2 investors, each starting out with a $100,000 portfolio. Investor A buys a standard index fund like VOO. They receive about $1,200 a year in traditional dividends, but they get to keep nearly all of the market's long-term upside growth. Then you have Investor B, who buys SPYI. They pull in a massive $10,000 to $12,000 a year in pure cash distributions, assuming yields stay consistent, but they have to give up a significant chunk of the market's future growth to get it. This perfectly illustrates the core choice every single investor has to make. Do you prioritize maximum long-term growth, or do you prioritize heavy, immediate cash flow?
And this brilliantly illustrates the exact difference. When we compare SPYI directly against a traditional fund like SPYI or VOO, we see they serve entirely different purposes. While both track the exact same S&P 500, SPYI gives you that high 10 to 12% variable yield using options, but sacrifices upside. This means SPYI is generally best suited for retirees who want monthly cash flow right now, or investors who are trying to live off their portfolio income today without having to sell their underlying shares. Conversely, a standard index fund is basically the go-to for younger investors, say a 30-year-old who doesn't need the income today and is strictly focused on maximizing long-term compounding growth over decades.
Which brings us to our final thought. Is SPYI inherently better than a standard index fund? Well, not necessarily. It completely depends on what your specific objectives are. The future of this stock and your ultimate success holding it depends entirely on the trajectory of the broader market. If the market goes up slowly, SPYI absolutely shines. If the market surges, you're going to lag behind. And if it crashes, you're still going to take a major hit. Because of this dynamic, many income-focused investors use SPYI as just one part of a diversified portfolio, rather than letting it completely replace their core index holdings. It's a tool. A highly effective, cash-generating tool for sure, but one that requires a deep understanding to use correctly. So how would a high-yield, capped upside asset fit into your own long-term strategy? It's definitely something worth thinking about. Thank you so much for joining me on this deep dive, and be sure to try out our latest explainers to keep expanding your financial toolkit.